So hello and a very warm welcome to the Data Explorers Daily Market Update, where I'm extremely pleased to be joined by Tejal Jolie, the VP in the iShares Capital Markets Division, who's given up some of her time to come and talk to us about what they're seeing in the ETF space at the moment. And we'll talk about some of the flows, some of the more popular names. And then we're going to talk a little bit about what iShares is doing to meet some of these regulatory concerns head on and go into more of the politics of ETFs a little bit towards the end. So first of all, thanks very much for coming in.
Thank you very much for inviting me. It's great to be here.
It's good to have you. And so, clearly this is a challenging market for a stock picker. Stocks are not really trading on fundamentals. They're trading much more based upon what Merkozy, as they're called, Merkel, Sarkozy, Berlusconi, what's happening in Greece. It's a very, very difficult time, and surely a better time to be investing in ETFs. So you're seeing kind of this is not a bad time to be offering what you're offering.
Yes, absolutely. And as you're well aware, one of the beauties of our ETF products is that they do provide exposure to an entire basket of securities and in effect allow you to diversify risk.
Yeah. So I've been one of those people who maybe sort of people trying to call the bottom of the market, trying to call the top of the market. Without you choosing individual names, it's obvious to go and buy some of the big ETF indices. What are the kind of particular ones that you're seeing most inflows into in the summer months?
So I think sovereign debt has definitely been on the agenda this year, and as a result we have seen for a number of months a risk-off environment where people have been moving their money from equity funds into fixed income funds, especially, for example, funds such as the Euro corporate bond, ex-financials, where financial exposure has been eliminated. And this seems to be a safe option for many investors.
So that's quite interesting. So that's a corporate bond that's stripped out financials. So if there is, I talked about safe havens, was it gold, was it the Swiss franc, the Apple shares, not much is safe, but maybe a basket of European high-grade corporate bonds with no financials is as good as it gets right now, and you're seeing that.
Yes, absolutely. I mean, I must say that in the last couple of months we have also seen a move into more of our flagship products. I think we're moving into a risk-on environment where people do feel comfortable about entering the market again in equities, and we're seeing flows once again into not only our high-yield fund but also some of the single stock emerging markets as well.
Right, and then the flagships being the kind of the DAX one, the FTSE 100 one, the S&P 500 ones.
Exactly, yes. Definitely DAX, that's been one of our best performers in terms of inflows this year. And the S&P 500, the Euro Stoxx 50 have also been performing particularly well in seeing.
So what's the AUM now for all iShares ETFs?
So the AUM, for the net new assets, I think is more relevant. Yeah. And the net new assets, as they stand year to date, have exceeded $17 billion US.
That's a happy place to be. I don't think many other fund managers can probably say that.
Yes, and we're very happy with that level. We're obviously trying to do the right thing in order to encourage investors into our funds.
Yeah. So in terms of, we talked about the risk being back on, we wrote a little piece about this week, and I think that this all applies pre the announcement of the surprise Greek referendum, which has got people no doubt throwing cups against the wall in the corridors of power in the European Union. But prior to that, this relief rally, there, what you did see a sense of sort of people starting to go into equity ETFs and out of corporate bonds.
Yes, absolutely. So a move back into equities, not only in the flagship products, but also the emerging markets, where we had seen in the summer months some outflows.
Okay, excellent. So we've seen from our data, just a couple of things that we've seen. We've seen that there's been August saw certainly in terms of European ETFs, there was a spike in borrowing of European ETFs as European hedge funds sought to essentially deal with the tumult in August through essentially hedging their long position by shorting some ETFs, and that saw a rise. And more recently we see it sort of falling away, which is people covering their shorts in some ETFs, probably going long the market in that relief rally we saw. We can also quickly talk about what we're seeing in terms of the supply. Obviously you're very keen to see more supply of ETFs in lending programs and more sort of liquidity there, and we are seeing that Europe's sort of catching up with the US. The US is the red line there, and so whilst it's miles bigger, you've got about 50-60 billion available to borrow of US dollar listed ETFs. That's actually been falling over the summer, whereas Europe is kind of steady and actually rising, so it's catching up. Reasons to be cheerful there.
Yes, absolutely. And the European ETF unit market remains in its infancy, and we are within iShares really attempting to grow the market, not only by speaking to agent lenders, prime brokers and custodians, but also highlighting the benefits of investors of putting their investments into a lending program to generate revenue.
Right, and that's going to be an ongoing, evolving process.
Yes, absolutely. It's something that will take a number of years to really get going and for us to see the effects. But I think it's a process that involves a number of counterparts to work together in order to ensure that we move in the right direction.
And something that's maybe not helping that right now, but will help it in the long term is the sort of the regulatory spotlight. It's been a sort of a difficult year, challenging year for the ETFs with all the regulatory interest and attempts to suggest that ETFs need to put their house in order this year. What are some of the sort of ways you're reacting to what the regulators are asking for?
So I think the phenomenal increase in the ETF industry has definitely seen a number of ETF issuers enter the scene in the last couple of years. Now this, as a consequence, has led also to a proliferation of products being offered into the market. As a result of this, I think it is completely natural that both investors and regulators are now concerned about the lack of transparency that there is in the market. Generally, exchange-traded products, whether they be exchange-traded notes, exchange-traded certificates, or exchange-traded funds, all seem to be referred to as ETFs. And I think that it is completely acceptable and expected that investors would like to know what they're investing in and be able to differentiate between the products when they're making investment decisions.
Yeah, and that's the sort of the nomenclature, the naming issue. It's a bit like hedge fund is this name that is this umbrella of sins, ranging from somebody who might have one short position for every 100 long positions through to a statistical arbitrage fund that has thousands of short positions is completely market neutral. It's an absurd term. An ETF suffers from the same thing. The similarities between a physically backed ETF backed by the underlying securities and a exchange-traded note where it's hedged by taking a position in the options market. But they're all called ETFs.
Absolutely, yes. They seem to be all referred to as ETFs, and as a result, we are taking measures in order to really improve transparency within the market. I must state that a lot of the regulator concerns that we have seen have been focused on structure, transparency and counterparty risk. And I think iShares fares particularly well in those areas. Having said that, if regulators and investors are having concerns about our products, then we have to ensure that we do our utmost in terms of ensuring there is further transparency within the market. We feel so strongly about this that we have actually produced a paper that puts forward proposals for regulatory and market reform. And the paper includes topics such as correct labelling of ETFs, ETNs and ETCs. It also includes universal trade reporting for all equity transactions, as well as a number of other points such as standards with regards to disclosure and standards with regards to multiple counterparties. So with regards to iShares, we very much welcome regulator scrutiny from a transparency and investor perspective. We're very much working for the best interests, or working in our clients' best interests.
Yeah, that's an impassioned response, and you're basically saying, transparency, bring it on. You're very happy to offer more and more of it, and you will win this battle for transparency because you've got nothing to hide, being physically backed, and you're prepared to offer it.
Exactly.
Which I think that I've heard people say, if you judge the ETF industry is moving to a situation where it's going to have so much more transparency information available to investors compared to investors in mutual funds. It's really slightly unfair that the regulators have singled out ETFs as being the next weapons of mass destruction, the next securitization. Just because they missed the last one, they're determined to sort of assume that the next popular financial instrument is a really dangerous one, which I think is overstated and is an oversimplistic view to take. So finally, when we get through, we've got more of these, so some more transparency being offered, and things are clearer, better labelling. Do we see this translating into more flow in the securities lending and borrowing market for ETFs?
We hope so, yes. I think the result of regulator intervention will lead to a general increase in activity within securities lending. However, I think there are really three main areas that will help push the lending market forward. The first, I think, is consolidation of listings. There are far too many listings in ETF products.
Multiple currencies for the same ETF.
Exactly.
Euro, Swiss, sterling, whatever.
Exactly, and this prevents
and
any
in the States,
sizable...
they've only got one. They're all in US dollars. It's simple.
Absolutely,
Europe's a very much a different
one
market.
listing in the US and maybe 6 or 7 listings for the same fund in Europe.
We may have to have a Greek currency, a drachma class coming out soon. Yeah, sorry.
Well, I think what we would like to do is see consolidation of listing, because what this will ensure is that there is sizable amounts of supply in the market in one listing only. At present, liquidity is fragmented amongst 6, 7 exchanges, and as a result, this really prevents the market from developing further. Despite the fact that ETFs are fully fungible, having to then change depository becomes a little bit of an issue, and one that I think borrowers would rather avoid.
Yeah. Your second point?
The second point would be consolidation of funds. There are too many funds tracking the same benchmark, and again, this prevents inventory being available in sizable amounts.
Yeah.
And thirdly, and I think most importantly, is probably the fact that we would like to have, we would very much like to have MiFID incorporate post-trade reporting requirements, and MiFID to include ETFs within the scope of post-trade reporting, and as a result, this will mean that all OTC transactions will be reported. At present, only around 40% of transactions are executed on screen.
Right, so therefore you look at the volume, which is the sort of, everyone's obsessed with, well, let's just look at how many days it would take us to trade in and out of this position, and then not looking at the full volume picture, are they? Because so much of the volume is OTC and doesn't go through the exchange.
That's right, and when we're speaking to lending agents who are considering accepting ETFs, for example, as collateral, if they're taking into consideration the average daily volumes, then that's not really going to provide a good indication of what actually can be traded and how much liquidity there is in the fund.
Yes.
Now, a move to incorporate post-trade reporting within MiFID will allow us to have additional information and provide us to have a better indication of what actually can be traded and what can be accepted quite easily by lending agents as collateral.
I think so. I think we'll have to sort of wrap it up there. So I think it's good that rather than just complaining about regulation, people are taking the bull by the horns and issuing their own papers suggesting what they should actually do, rather than just carping, being constructive, and then also making efforts to shape MiFID in a direction that you want it to go in to be helpful for investors, and the liquidity of the product is to be welcomed as well. As I said in a piece I wrote about ETFs, I think one thing they can console themselves by is, as Oscar Wilde said, it's one thing worse than being talked about is not being talked about. Because you're successful, is attracting attention. And I think you've got ways to deal with that attention. That is all. If you'd like to read a quick summary of this discussion, please go to dataexplorers.com/news.